Hello, I'm Brian Beaulieu from ITR Economics. Thank you for joining us for this edition of FedWatch. Today is January 26, 2024. We're going to really 6 points to cover, but I'm not going to belabor any one of those points. So we'll stay within the parameters of what we need to do. First is the fourth quarter GDP number is out. It's the prelim number, but they don't usually change all that much. Although it's noteworthy that they changed the third quarter downward a little bit, that indicates that they have a bias toward overstating, but again, it won't be much of a change. The fourth quarter GDP number came in stronger than we thought it was going to be. And that's a good news, bad news type thing. It means that we're going into 2024 in terms of GDP in slightly better shape than we had anticipated. We're going to put that forecast under review. It was interesting that what was driving it was primarily personal consumption expenditures. And besides the usual shelter and medical care impetus, we saw a lot of movement, a lot of activity in terms of recreational vehicle purchases and going out to eat. Two things that were very weak during the COVID period and remain very robust right now. They were initially weak, at least going out buying those types of vehicles. I think maybe a whole generation learned about them or fell in love with them. I don't know, or if it's bad, but that's really the surprise elements to their personal consumption expenditures. But it wasn't limited to just that in terms of consumers feeling good about how things are going. New home sales were also up in the fourth quarter. That's a separate data stream. Came in for the year at 4.2% above 2023. The 12/12 rate of change is in phase B, which is great. We have an average seasonal decline going on in the monthly data, and that's better than the last 2 years. So that's an encouraging sign. And that was followed up by single family housing permits really doing well for the fourth quarter, coming in 22.9% above last year, 22.7, sorry about that, a year ago, the fourth quarter. That's in strong phase B. And I just was doing some client work, and most of the states are in 312 phase B when it comes to permits. So the housing looks like it's coming on really fairly strong. Not stronger than we anticipated, but on par with what we have seen over the last 40 years or so. So it's good. So that's all good news and bad news. It's good for those of us that are pulling for the economy to continue to do well. It's not so good in terms of us pulling for seeing interest rates come down in 2024. Still leaning in that direction, pretty positive it's going to be that way. And one of the reasons for that is the Federal Reserve seems to be relaxing in terms of their quantitative position on easing versus tightening. The money supply was very robust on the upside in December. And now short-term fluctuation like that could be because of market forces, not necessarily the Federal Reserve. We'll know better about their intentions, as I said last week, in March and April. We'll really get a good bead on whether they're planning on seriously quantitative easing relative to the tightening we've been on for the last 2 years. Incomes, after adjusting for inflation, were at a record high in the fourth quarter, and that rate of change is positive at 2.9%, phase B. So incomes are up, we're spending more, the money supply seems to be easing. All of that has us thinking the Fed may be taking a real hard look at this data, and if it continues, well, I don't think they're going to do anything this month, by the way. They're meeting in about 9 days, 6 days. They're not going to do anything with interest rates this month. So if you look at the futures market, it says there's about a 50% probability of interest rates coming down sometime in the first quarter. I don't think that's going to happen, not with this strong fourth quarter showing. We're still saying that there's a probability of an interest rate decline, 25 bips in the second quarter. But we'll have to see the economy weaken considerably from where it is today. The leading indicators are suggesting that there's another round of weakening coming in retail sales. That's our take on it. We're also doing diving down into the credit markets and looking at inventory trends for 2024 to try and get a bead on what to expect out of these interest rates. So we're holding with 2Q, and the futures market says that there's about a 91% chance of interest rate decline in the second quarter, and that's up considerably from the last time I brought that number to you. So all in all, it's good for the economy, but not good for seeing interest rates come down, which is not good for 2025. So it's a mixed bag, but if you're playing in the overall economy and you're not interest rate sensitive, this is going to be considered good news for you. If you are interest rate sensitive, the strength in GDP is not particularly good news. Depends on what you do in your interest rate sensitivity, which is something our team of trusted advisors would be perfectly willing to help you figure out. Thanks for watching this edition of FedWatch. See you next week.